Accounting for inventory. The term inventory refers to products that a company purchases with the intention of reselling them for a profit. Depending on the type of company you're in, what counts as inventory can vary. A company that buys and sells computers, for example, will count computer sales as inventory and log them into the purchaser's account. However, another firm may consider the purchasing of a computer to be an asset, and the purchase will be recorded in a computer account. Many accounting students are uncertain if anything qualifies as an asset purchase or inventory purchase at first. This distinction between asset purchases and inventory purchases is critical because it has consequences for measuring the business profit later on. Inventory refers to goods purchased with the intention of reselling them. Inventory is an asset, so that it would be governed by asset accounting law. Inventory is an asset and will therefore follow the rules of an asset account. Consider the following account. It's tempting to believe that this account has no balance because the inventory bought in April was all sold in May. However, it's likely that the inventory's sale price was different from the inventory's purchase price. As a result, you won't be able to tell how much inventory is left in the store. The solution is to have separate accounts for different movements of inventory. There are 4 separate accounts to record different movements in inventory. Purchase, for purchases of inventory. Sales, for sales of inventory. Returns inwards, when a customer returns inventory to the firm. Returns outwards, when the business returns inventory to the supplier. Double entry transactions for inventory. Inventory is an asset, so it would be governed by asset accounting law. It's likely that all purchases and sales will be for immediate payment or receipt, in which case they'll be called cash transactions. They can, however, be on credit terms, meaning that payment or receipt is deferred until a later date. It's worth noting that the word cash, as in cash sales, may refer to payment or receipt by check. It's only called cash to differentiate it from credit terms. Credit terms are normally offered when one business trades with another business. The credit period offered can vary, but 30 days is a typical period offered. The double entry transactions for credit transactions will be completed in 2 stages. Firstly, the initial credit transaction, and secondly, the payment made or received in the final settlement of the account owing or owed. Returns of inventory. It is possible that goods will be returned to the original supplier. This is not something that the supplier will allow automatically, but if there is some issue with the order, such as the order itself is incorrect or the items faulty, it is normal practice for the goods to be returned. Both returns inwards and returns outwards are an asset of inventory accounts and will therefore follow the rules of an asset account. Returns inwards refer to the goods which are sent back to the firm from the customer. For this reason, they are also known as sales returns. Drawings. It is perfectly possible that the owner will take resources out of business for personal use. Resources taken out of the business by the owner are known as drawings. As the owner will be withdrawing assets from the business, the relevant asset account will be credited. The debit entry is in the drawings account. Hence, the double entry for drawings is completed as follows. Income and expenses. Businesses will incur expenses as part of their normal trading operations. Common expenses incurred by businesses would include rent, insurance and wages. In addition, the business may have other income in addition to the sales revenue earned from selling goods. Additional forms of income for the business may include rental income. The double entry account transactions to record income and expenses are straightforward. Payment would result in the bank or cash account being credited, so the debit entry for this transaction must be in the applicable expense account. Similarly, if money is collected as company profits, it will be debited from either the cash or bank account. This means that the credit entry for this transaction would be in the relevant income account. For expenses. For income and other revenues. How many different expense accounts should be opened? Every cost incurred by the company should be recorded in its own account. However, Some of the smaller expenses, such as tea or coffee for a staff office, can be held in a general or sundry expenses account. It is better to keep each expense separate to provide information for the managers of the business as to what expenses are being incurred, thus giving them information that can be used to control these costs and prevent them from rising too quickly. Another way to keep the accounts separate is to keep the spending and revenue accounts separate. Some businesses, for example, will keep separate accounts for rent as an expense and rent as an income. The account dealing with rental income is referred to as rent paid, and the account dealing with rental cost is simply referred to as rent. If it is not sure whether the dealing with an income or expense report, look at the entries in the account. The expense account will have a debit entry relating to the method of payment, as seen in the example above. The money paid for the income will be debited to either bank or cash, and the income will be credited to the income account. Balancing accounts. The double entry accounts would be balanced at the end of a given accounting period, which may be weekly, monthly, or yearly. The primary goal of account balancing is to allow the production of financial statements for the company. When balancing off accounts, the averages of the debit entries in each account are compared to the sum of the credit entries. The difference between the sum of the debits and the total of the credits creates the account balance. General rules for balancing accounts. Although balancing accounts is fairly straightforward, it can initially cause problems. Most problems can be avoided if the following points are remembered. Balances only exist if there is a difference between the totals on each side of the account. The totals of each side of the account are not the balances. The balancing figure on the account will be the amount needed to ensure the totals of each side are equal. Ensure that the totals of the accounts are written on the same line down. Bring the balance down to the opposite side of the account from the balancing figure. Summary. The maintenance and recording of transactions are known as double-entry bookkeeping. The name of the account refers to the type of transaction. The inventory's selling price differed from the purchase price of the inventory. Returns inwards and returns outwards are an asset of inventory accounts. An account should be opened for each separate expense generated by the business.